Welcome back. We are smack dab in the middle of November. Thanksgiving is coming up on us. This is wild. This year has just flown by. I want to help you guys really become great traders in 2026. And I think that you need to master these concepts and accept them because a lot of trading is about psychology, okay? It really is, and about your mindset. So these are concepts that I think that you need to master if you really want to hit a new stride with trading in 2026. So here we can get into it. Number one is the stock market is an equal opportunity space. Okay? It doesn't matter who you are, where you come from, your gender, the color of your skin. None of that stuff matters to the stock market. The stock market doesn't know who is buying or selling anything. In fact, a lot of the buying and selling that's done on the market is done through algorithms anyway. So someone out there is killing it right now when you're not. And you can also make serious bank when somebody else is struggling. So your results are a direct correlation to the choices that you are making. And this space is equal opportunity. If you're struggling during a bull market, there is a problem. And if you struggle in a bear market, that's normal. Okay, you might struggle in both. And if you do, please reach out to me. I have a mentorship program and I can help you not struggle so much in either one of these markets, but I can also help you understand that struggling in a bear market is just kind of normal. Okay, and it's great to have friends, and we have a lot of friends in our group. Okay, no one celebrates when the market goes down. There's some belief out there that there are people that just make a killing when the market goes down. And there are traders or hedge funds that make a lot of money when the market is going down. At the same time, they are disappointed, though, that their longs have lost value. For every trader there is out there that is trading these directional moves, those traders also own longs, and they're never excited when the market goes down. I mean, they like to make money that day, don't get me wrong, but they would rather see the market move to the upside because it is so much easier to make money when the market is moving to the upside. So don't fall for the belief that you could potentially just do so much better if you knew how to trade to the downside and that was your core strength, because somehow the bad days would never hurt you. That's simply not true. I've never found that to be true. And I know a lot of traders. I'm even a member of a day trading group that I will listen to in the morning as just sort of chatter in the background, like a radio. And whenever the market moves against the bullish pattern, the tone in the room shifts quite a bit and they aren't really happy because everyone there is long on some things and no one can time the market. Okay, no one can time it. So no one makes more money when the market goes down. No one. There might be a couple people, but in general, no one makes more money. Here's the bright side. Can you still make money? Yes. The thing is it won't be as much money as in a bull market. So as long as you can accept that, you're going to survive in the market and thrive in the market. The reason why you can still make money in a down market is because there are strategies for that. The bear call spread comes to mind. There are even diagonal spreads that I do that continue to print a lot of cash when the market is down and going down further. The reason why we don't tend to make more money when the market goes down is because as our accounts lose value on our longs, we have less collateral to trade against. So at a certain point, you are going to be restricted and confined by a portfolio that is going down on your longs if you choose not to sell and go into cash. And so that will impact you in some way. The exception here is probably day traders. But day traders don't necessarily always have it the best either because they have to come in with fresh cash in the market every day or sit out of the market And it's not a prettier picture there. So don't be misled to think that day traders have it easier than options traders who are selling longer contracts. I just don't think that that is the case. Okay. So nobody likes it when the market goes down. Okay. Nobody does. You got to give yourself grace when the market falls, because no one, and I mean no one, can time the market. I get questions about this all the time about, Erica, what do you think will happen here? What do you think will happen there? And I always say, I don't know. No one knows. No one knows. No one can time the market. No one can time the bottom. No one can time the top. So the more that you get okay with that, the more freedom you have to just make a move instead of acting out of fear. Okay. Shorting the market is far riskier than betting on the upside. So this is number 3. Again, it's really hard to make money when the market is going down or to bet against the market. The market is usually expanding. It is usually moving to the upside, and it is usually growing. The market contracts and goes down with less frequency, goes down less often, and less of the overall time on the market historically is the market going down. Okay. So number 4, making hedges slows gains, or it brings down your gains. When we buy a protective put, for example, it takes percentages off of our gains. A hedged portfolio grows slower. If you buy puts, they pay with less frequency and make less profit most of the time. This is a big concept here. These are 3 different concepts, and they can work independently of each other and they can work together. So let's go over these one more time. When we buy a put, it takes percentages off our gains. Okay, so a strategy that you might have heard of is where if you own 100 shares on something, you might buy a put that costs you something like $500 to protect those shares so that you can put the shares on another trader if the shares drop in price. Okay, so if that's the case and you're doing that frequently, your gains when the stock goes up is offset all the time by buying those protective puts for $500 a pop whenever you're buying them. So you diminish your gains. A hedged portfolio grows slower. So that is really point number 1, shows you that point number 2 is true here. Okay. If you buy puts in general, they pay less frequently and make less profit most of the time. So here's what I'm talking about here. When I've done this before, because I thought, hey, wouldn't it be smart to buy some puts as protection on my shares? I didn't ever buy the puts to put my shares in somebody else. I actually bought them to cash them out when the puts would increase in value. The thing is, they rarely increase in value. So most of the time, since the market was going up, most of the time I was losing money buying the puts. So people ask me all the time, are you buying protection all the time? And I say, I buy protection actually very rarely because I find that it loses me money most of the time. And I believe in a bullish market most of the time. And I'm willing to take the losses off of a bull run correcting versus stagnating my gains on the whole way up. That's a choice you have to make though. Okay, so you have to choose between 2 things on number 4, on making hedges slows gains. You get larger gains when the market rises with little protection, or you can get smaller gains with more protection. Getting both at the same time is really not that likely to happen. So you got to pick what you want to do. For me as a trader, I know how to make such insane money when the market is going up that what I try to do is I try to make an absolute freaking killing on the way up because it's going up most of the time. And my portfolio bleeds more on sell-offs, but I'm okay with that because I absolutely kill it on the upside. And the sell-offs don't last that long. And that's what works for me. There may be something else that works for you. So I'm not telling you you're doing it wrong if you choose to have more protection. What I am saying is that there's a thing that traders have to accept. And you have to choose which style is right for you. I'm not saying my way is right. I'm saying that my way is right for me. Okay, so you got to make your own choices because you're an adult and you're a trader and you get to make these choices. But let me say the two things you have to choose between. Again, you can get larger gains when the market rises with little protection, or you can get smaller gains with more protection. The choice is really yours. Okay, number 5, rise and fall are different on the stock market. Okay, so the market can rise rapidly, but it falls much faster when it has a reason to fall. When bad economic news hits, it falls so fast, it's difficult to catch the fall. So if you are thinking to yourself, hey, the market is falling right now, I think that I'm going to buy some puts. A lot of times you've already missed the fall by the time you think about buying the fall because it happens so fast. And today is November 18th. So last Friday, we had an 800 point or 700 point fall off in the Dow. It happened so quickly that unless you were a day trader, you probably missed it, or you saw it happening and you didn't know at what point you were supposed to catch that. That's difficult for anyone to know unless they are an avid chartist. So try to give yourself a little grace here. It is far easier to ride the waves up and catch those because the market rises. The market in the United States, it rises really fast, don't get me wrong. But the rise up compared to the fall off, it rises like walking and taking the stairs up the high rise, and it falls like taking the elevator down. That's the analogy a lot of traders use, and that couldn't be more correct. So catching rises is far easier than catching the fall. Okay, number 6, patience wins. So results often don't happen as fast as we want them. The market doesn't care what we want. The desire to constantly be doing something or anything and look around for a stock that's flashier or a better opportunity can cost you a lot of opportunities that come from simply doing nothing at all. Don't trade every ounce of your portfolio. Hold positions. Just go long on some stocks because really great news hits great stocks and makes those stocks rise really quickly. So you don't want to have all of your shares under covered calls to cap their gains because sometimes those stocks just rip and you want to be there to catch that. So patience wins. Patience wins in more ways than this, and I'm sure that you know that, but there are so many ways to be patient in the market. I don't even think we can go into all of them, but patience will win. Again, these stock moves, they don't happen on a timeline that we want or really that we're expecting. Even the best chartists are sort of wrong like 25% of the time. So that's just the way the cookie crumbles, unfortunately. Or fortunately, you know, good things happen to good stocks. So there are times when you will win just from being patient. Number 7, sell your losers and keep your winners. Figure out when you will sell a stock that simply isn't rising when the market is overall, and move those funds into a stock that's doing well for you. There are so many people that are just afraid to hit that sell button when they're on a 20% loss on a stock. And they just kind of want to keep selling covered calls on it for the income. But the stock is kind of continually going down while the market's kind of continually going up. You'll never catch up with a stock that's doing that. You'll never catch up with covered call income to offset the loss in the share value, because what's happening is that the institutions are moving out of that stock and they've decided they no longer like it and they no longer trade it. And it's going to be hard to undo the damage to the stock that they're doing to it. You aren't strong enough to overcome that action of their selling. So don't pretend like you are. Good stock picks. This is another hard one right here, okay? Good stock picks can turn into moderate to poor stock picks as geopolitical, business, technology, and social trends change. So you have to date stocks, not marry them. You can't like dig in your heels and say, I'm Apple forever. For right now, I'm probably Apple for the next 2 years. I don't see that picture changing. But am I going to say I'm Apple for the next 20 years? I don't know. There could be something better that comes along. And if that better thing comes along, I'm for sure going to move my money over to that better thing. I mean, I love working on my Apple computer. I started working on an Apple computer when I was a kid and never switched, never had any other computer. So like I was into Apple before it was cool, way before it was cool. I never understood how you people could use other computers because the Apples are so intuitive. And I would try to convince everyone of that. Anyway, that could change. That could change in the future. So, the thought that comes to mind for me is some of the Tesla people who were just so believing in Tesla, even was dumping, that it was the product of the future and they had the products of the future and whatever. And when I think of how much money they had left in that stock and they were bag holding for it finally to take off, I'm happy for them now. But the amount of opportunity cost and losses they incurred from just staying in that stock for it to do nothing for so long, I think was a big missed opportunity. Okay, so number 8, major pullbacks mean new trends emerge. So every major pullback is caused by some economic or geopolitical event that changes the face of planet Earth in some way. It just does. So if we think about the last major pullback, that was 2022. Which was the story then was about inflation, rising inflation. Rising inflation is really bad for the stock market. A war broke out. And then we had this whole post-COVID shift in culture. Like people didn't want to work as much. There wasn't showing that maybe there would be as much growth, things like that. And that was concerning. They had multiple economic factors and culture shifts that were sort of pointing out to danger. We don't really know what to expect next. So there was a pullback. As the changes set in and the picture changed where we got inflation sort of under control, things of that nature, the stocks that came out of that time period that were popular were different than some when we entered. So I will give you an example of 2 stocks that kind of like changed in COVID. Okay, so 2 of the examples I'm going to give you, one was Pinterest. Pinterest did phenomenally well during COVID. Like we went into COVID and it did really well because everyone was home and they were doing stuff on their computers, and that stock really had a boom then. By the time we get to 2022, that stock is falling because nobody is like home all the time anymore. And they're not seeing this same growth that they need to see, bringing viewers and members into their channel on the Pinterest on like either your computer or your phone. So they start losing market share and advertising revenue, which is very bad for the stock in general. So that stock loses value because the culture changed. That's why. Another one is Nike. Nike was doing phenomenally well in 2020. They had some issues with getting merch out to people because some of their factories were shut because they were in third world countries or some of these developing countries, second world countries, and they had a longer time recouping from COVID than we did in the US. So they had a really hard time getting orders out to people. So they didn't have as much merchandise that they needed to ship. Like things were just sold out. So what did that do? The consumer had to turn to other brands to buy them because they still needed their joggers and their leggings and their sweatpants, sweatshirts, and athleisure and athletic wear. So they turned to other brands. These other brands sort of see this happening and start inventing all of these new products that are really luxury. Lululemon comes out with these amazing fabrics. So does Vuori, things like that. And clients, their client base tries these other brands and then starts to prefer them. So Nike stock crumbles. There's a change there. So there are changes in the world that are happening when there's a pullback. If we get a pullback now we're currently in a little pullback. It could go bigger. I'm sure a lot of you are feeling it right now. It's November 18th, 2025. The reason we're having a pullback currently is because the government was shut down. There's no data coming in. And so when I say people, I'm talking about the institutions. Institutions need that data to know how to trade and to know how much money to put into the market, how much money to take out of the market, etc. They don't have data. They don't have data for 45 days for a government shutdown. That makes them insanely nervous. And they're worried about some of those numbers coming in that they may not be good. Because if they're not good, they're going to pull even more money out of the market because they don't want to be in it as much anymore. They'll start gradually pulling as economic data gets worse. They'll pull more and more out. The economic data that they're probably looking at right now to pull money out of the market if they need to, if they see a reason to pull it out, it's going to be probably based on two likely things. The first would be unemployment. If unemployment ticks up or the job number, the new jobs goes down, that's going to be bad. It's not going to be good. Because it's coming off now as like a little bit of a surprise because we've had 45 days with no data. That's not good. We don't like that. Okay. So all those accounts on Twitter or whatever that were saying, hey, do you guys notice how like the government shut down and nothing happened? It didn't affect. We don't even need a government. You do if you're a trader. Yes, you do. You need that. Okay. So that's kind of where we are with that. The other indicator that I would be looking at is inflation. If inflation keeps ticking up, that's going to be not so good. So those, and if those two things come back together as the same, like in the same month as both going in the wrong direction, that's two bad things, and that can make new trends emerge. So if we get a larger pullback, if we go into something like a 2022 again, the stocks that come out of that market will shift. I'm not saying that Apple won't still be a winner or Amazon won't still be a winner, but there may be something like a Hims that falls into the ground because like maybe a new better weight loss / hair company emerges because of whatever. We don't know, but there will be a change. So the stocks that go into pullbacks that are doing well may emerge as not doing well when they come out of it, and new stocks can present themselves to come out of pullbacks in much better positions to rise. So you need to watch that. And how will you know? How will you know which ones to get into? Because those stocks will rise and they'll rise first. That's how you know. So you kind of have to jump into bed with the stocks that are doing well. Okay. This is not, I always say you have to, although I think it's insanely tacky and unbecoming as a human being to suddenly change into a Green Bay Packers fan and you always were a Bears fan because the Packers are going to the Super Bowl that year and you're just like, I am a fair weather fan. There is nothing less attractive to me than that in a human being because that's just gross. I don't even like football, but that's gross. There is you have to be that way with stocks. You have to be that way. Okay? All right. So I dump shares on any stock that stays stuck in these pullbacks when the stocks start moving up, when the market starts moving up. I dump shares in any stock that stays stuck, and then I rotate my shares into what's looking good for the new economy coming up. And I will know that because those tickers will start to rise. Number 9, this is our last one. Great traders like change. Okay, I always liked change. Maybe that's what makes me a good trader. I know other people really resist change. My husband does not like change. My dad does not like change. There are people around me that just really do not like change. I like change. I sort of get bored with the same old, same old. But here's the truth. Inflexibility and stubbornness lead to losses in the market. You got to listen to the data. Don't let your own preferences cloud your judgment on what everybody else needs and wants to buy. And I'm talking about products and services here. Traders like change and they like learning. They'll try new things. The market changes, and so strategy must change with it. So that's a wrap. I hope this helps you embrace the concepts that I think you need to embrace if you really want to raise your game in 2026. For a lot of you, you've already mastered some of these. So I challenge you to just master one or two more as your New Year's resolution. There's one more actionable step you can take to being a great trader in 2026, and that is you can join me and my Millionaire Mentorship Group. We have 78 other members as of now on November 18th. We all make great money together. We have a lot of fun and help each other out. I think you'd really enjoy it, as well as staying on top of your trading game and growing.